So someone sent me a research report from Morgan Stanley on Lemonade, and we're going to take a look at this report, compare it to my model, and have a couple of conclusions after all that to share with you guys. I can't share the details of the report itself. I shared them on my Patreon. If you want to support the channel, you can join there and see that. But the sender of that report asked that and not share it publicly, as he doesn't want it to be widely spread. So inside of my Lemonade model, I have my current projections and model myself, but then I have a Morgan Stanley comparison tab here in blue. And I have different comparison lines here where I'm comparing their annual estimate for, say, 2024 versus my quarterly estimate for the full year, 385 versus 389. And Morgan Stanley in their model starts with net earned premium as their top line. Net earned premium is your gross earned premium, but with your reinsurance removed from it. You have your in-force premium at the top, and then you take out, or then that converts to gross earned premium, and then you have net earned premium, which is after your reinsurance is taken out. So the bigger the reinsurance, the bigger the more effect it will have on your net earned premium. And in these early next few years, their net earned premium is actually pretty similar. So I have 277, they have 295, they have 389. I have 385 for 2024, 507 versus 558. But then if we fast forward a few years into profitability for Lemonade, where their model is profitable, mine is more profitable, start to look at even, say, 2030, I'm at 1.95 and they're at 1.66 net earned premium. So it starts to sort of diverge here, and this gets more and more significant. They have a 10-year model, so it's looking all the way out to 2033. So 2031, I'm at 2.7 and they're at 2. 2032, I'm at 3.7, 3.6, 3.7, they're at 2.5. 2033, the end of where their model shows, I'm at about 5 billion and they're at 3 billion. So it starts to really diverge in those later years. But the divergence here isn't really that crazy, especially when you're thinking 10 years out in time. But what's even more significant in their model, if they look at their ceding commission that would come back from the reinsurance, that really tapers down. And that goes from about 30% of their net earned premium in their model in the sort of current years around where we are now, all the way down to about 2% by 2033. So that basically means that they're expecting very little reinsurance. My understanding is I think they're expecting very little reinsurance in the later parts of this decade as Lemonade starts to become profitable, that they're going to really turn down the reinsurance. But it also means that if their net earned premium is still not too far off from what mine is, but their ceding revenue from reinsurance is dropping down to almost nothing, it means that their gross earned premium and their in-force premium, which they don't actually show on the model, but those numbers must be significantly less than what my model has. And you can even see this in their total revenue line after you get ceding revenue added back in. We're at about 396 for this year, and they go to 2033 and they're at about 3.2 billion. So 396 to 3.2 billion, it's about 26% compound annual growth rate over those 10 years. But in my own model, I have 372 for this year, and you fast forward all the way to 2033 again, and I'm at over 8 billion, 8.2 billion. So the difference there becomes much more obvious, that sort of change. And that 372 million to 8.2 billion over 10 years is more like a 36% compound annual growth rate versus the 25, 26% kind of their modeling. Rolling down and looking at total expenses, I'm also assuming they're going to have much more operating leverage in their expenses and their operating expenses. The dollar numbers of my expenses grow larger than theirs, but that's only because my own top line is growing much larger as well. So in the end, my operating leverage is much more significant, at least how I'm modeling it. Of course, nothing on this channel is financial advice, could be wrong, but that's how I'm modeling a company like Lemonade. So total expenses now, we have 392 versus 389. We fast forward though, let's go to 2033, the end of the model. They're at 1.2 billion versus I have 2.6 billion, but of course, that top line revenue was so much different. It was 3.2 billion versus 8.2 billion. That revenue number that we just looked at here, this total revenue after your ceding commissions are added back in. And if we just compare adjusted EBITDA, over the next few years. They're pretty similar. I have 190 for this year. They have 200 around what guidance is now. They have 181 and then 116 versus I'm at 172 and then 110. And they get to profitability in 2027. That's what I'm modeling as well. I think there's a chance Lemonade does it sooner than that, but at least that's why I have punched into my model. So this is my line here again. I have about 98 million in adjusted EBITDA profit in 2027, but they only have 2 million. It's much less significant. Then you fast forward all the effects of that revenue, all the effects of those operating expenses, how those are both growing. You get out to the end of their model, 2033. They're at about 420 million in adjusted EBITDA, but while I'm at, for the full year of 2033, I'm at over 2 billion. So it's about a 5x difference in the bottom line when you consider the operating leverage and the change in revenue at the top. So 2 conclusions from this for me. First one is I think they're underestimating how quickly Lemonade could grow if they wanted to. Their whole structure being a completely digital company. They don't even necessarily need employees in a new state or a new country to move into. Really tells me that they could grow very rapidly and really push for growth if they wanted to grow or if they were needing to grow. So I don't know why after they become profitable, you would expect the growth to kind of taper down. In my mind, they might continue using reinsurance just so that their own capital needs are lighter versus the amount of growth they have. I mean, if your unit economics are improving to the point you have enough products in enough places and they're bundling enough ways and you have enough underwriting data to target the right customers and cancel out the ones you don't want, then if those unit economics are reaching profitability, then you'd think you'd just scale as even harder than before, and you'd use any new funds to continue growing because the whole world's a huge place. The insurance market's a huge place. Even when I talked to Daniel, when I did an interview with him, I asked him whether they would ever come to Canada. And he said, basically any country in the world, you could ask that same question. Would Lemonade Insurance ever be in blank country? And he said the answer would be yes. That would be their hope and their ambition. So the growth ahead of them in my mind is way, way bigger than what this Morgan Stanley model is showing. And it could be that Morgan Stanley is just thinking of them more as a typical insurance company where they actually build physical shops. They set up more extensive agent networks and sales and distribution networks and wherever they're going to. This is versus, Lemonade, that everything is digital and customers get the app and sign up. I also think they're underestimating the amount of operating leverage we should see or could see. And I just want to remind you of a SAY question I had from Q4 of 2022. I asked about how they're really trying to trim operating costs and overhead. And one of the things Shai said is it's worth noting our expense ratio today is built for scale. We should be able to continue to grow very significantly without matching increasing costs. So what Shai said there really makes sense to me when you look at how Lemonade is built. And that's why in my own model, if we flip over to my own model and graph, I have total expense ratio as a percentage of gross earned premium really trending down to, later this decade by 2030, about 17%, all the way down to, 14, maybe even 13% by later 2030s. Anyways, I'd love to hear what you think from this comparison. If you want to get access to this full Lemonade model, please consider supporting the channel, joining my Patreon. You can also then see the full research note here as well. And I'm also doing some exclusive videos, such as talked about Lemonade's automation index the other day, just for Patreon members. So thank you for all you wonderful Patreon members who support the channel, and for everybody else for watching. Thanks so much, and remember, it's in the bag.